Hello and great welcome. So now in this particular session we are going to begin cash flow statement, and this is something which you have already gone through several times in your earlier phases of education. So most of the things you are already in the know, but still we are going to pick this particular chapter right from the sketches as we normally do. Now, from the examination perspective, quite obviously, this is one chapter where you can expect a long question. In fact, there are two chapters from where long questions can be expected, as I've already told you. One happens to be preparation of financial statement, and the other one is cash flow statement. And generally, the question which comes from cash flow statement is not very easy one. Let me also caution you over this particular point. So, coming over to the business end, cash flow statement, what should I tell you? Because most of the things you already know. Correct? You are already aware of, in fact, cash flow statement, because you have done this chapter several times in your earlier phases of education. So cash flow statement, first of all, you need to understand what exactly cash flow statement. Obviously, the name itself is suggesting cash flow statement means the statement which simply shows the flow of cash. Flow of cash and its equivalent. Flow of cash and its equivalent. So there are two important terms, cash and cash equivalent, and you should be absolutely aware of these two terms, correct? Although it looks very simple thing, but sometimes actually we get confused, so that's the reason actually you need to understand quite well. When we say cash, what we mean by cash actually. When we say cash, first of all, you need to understand cash basically means cash in hand. Cash in hand, and it also includes demand deposits. Now, many times I have seen actually students are not aware of what we mean by demand deposits. Demand deposit means such deposits with the bank that can be what we call demanded back from the bank at any point of time. In simple words, it is nothing but your cash at bank. So whatever amount which you have deposited in the bank, you can demand it from the bank at any point of time. This is what we mean by demand deposit. So when we say cash, I hope now it is absolutely clear to you what we mean by cash. Cash means cash in hand, and of course the demand deposit. And demand deposit is nothing but the deposits which you have actually kept with the bank, because such deposits you can demand from the bank at any point of time. Cash equivalent. What we mean by cash equivalent? When we say cash equivalent, honestly speaking, cash equivalent simply refers to such securities, the entity is having some securities. Securities means you have made some investments. So cash equivalent simply refers to such investment or securities that is matured within a period of 90 days or 3 months. Within a period of 90 days or 3 months. In simple words, cash equivalent simply refers to such investment or securities which you can encash within 90 days or what we call 3 months without losing anything. Without losing anything, what we mean by that, suppose if I have got 1,000 shares of a particular company of rupees 100 each, so the total value is equal to 1 lakh. And within 3 months, if I am able to get something near about 1 lakh, that is 1 lakh or 9,99,000. So it would mean actually that or 99,000, 1 lakh or 99,000. That means I am getting almost same figure. I am not losing much amount. So if we can get this almost same amount within next 3 months, such investment are classified as cash equivalents. Is it clear to you or not? So generally under cash equivalents, we include marketable securities and short-term investments. Is it clear to you or not? Provided they are satisfying this particular condition. So this is the point which you need to understand. And as I told you, generally under cash equivalent, we include marketable securities and short-term investments, unless otherwise stated. Suppose in the question in the balance sheet you are being given short-term investments or marketable securities, you will have to consider them as cash equivalents. Is it clear to you? Short-term investments or marketable securities, because in that case we presume that they are maturable within next 3 months without losing anything. This is what we mean by cash equivalent. Now, before we move further, what is the importance of why an entity actually prepares cash flow statement? This is another important point which you need to understand. Why we prepare cash flow statement? The problem is that an entity prepare cash flow statement because when an entity will prepare a profit and loss account, or for that instance balance sheet, when an entity prepares profit and loss account and balance sheet, as you can see in this case, the flow of cash is not represented because profit and loss account is prepared over a period of time, but it is not going to what we call represent the flows of the cash. Similarly, when company will prepare balance sheet, it will simply reflect the position on a particular date. Correct? So that means through profit and loss account and what we call balance sheet, we cannot derive any idea regarding the flows of the cash, and which play a very important role from the investor's perspective before they invest their money into a particular company. So on account of these two drawbacks, or on account of these drawbacks of P&L and balance sheet, because they do not represent, as I told you, flows of cash, the importance of cash flow statement gets enhanced, because cash flow statement, as I told you, will give you a reflection or give you a picture, complete picture of the flows of the cash, and investor always take into account flows of cash before they invest their hard-earned money. Now, as I told you, many a time I have seen actually students know everything. You know everything, what is cash flow statement and how it is prepared, how many headings it has got, cash generated from operating activity, investing activity, financing activity, everything is known to you. But still, I have seen actually the sort of knowledge which you need to have actually, many a time student fraternity is not able to actually reflect that. So you must understand the importance of cash flow statement, and how that I will let you know. For example, let us say there is Mr. A. There is a person, Mr. A, and he wants to invest rupees 10 lakh in a particular company. Correct? Mr. A is interested in investing his hard-earned money of 10 lakh. Correct? So that he can have some return. He has some general knowledge of accounts, but not very high class or in-depth knowledge. He has got general knowledge. Now, let us say he started scanning the financial position of different companies, and suddenly he finds that there are 2 companies where he is quite interested in investing. But he is not able to make up his mind that out of these 2 companies, which one he should prefer. Then ultimately what he does actually, he simply goes through the profit and loss account of the respective balance sheet of these 2 companies, of the respective companies. He finds that profit position of this particular company is higher in comparison to this particular company. He finds that profits of company 1 are pretty high in comparison to company 2. So what he does, without applying much of his mind, he simply invests into this particular company because he gets flayed by the what we call profit and loss account. He thinks that profits of this particular company is high in comparison to this one, so it is better to invest in this particular company. Well, after 1 year, and moreover, what he saw actually that this company has paid quite high dividend. So he thought it is better to invest in this particular company because he will have a good amount of return. So on such lines, he invested his hard-earned money into this particular company. But after 1 year, that particular person became very anxious and very disappointed and very almost dejected, because what he thought of earlier while investing, he did not get the sort of return after the end of the next year. Is it clear to you? So when 1 year has gone by, he was expecting a good return. Let us say last year this company had delivered a dividend of 20%, but in the current year this company gave a dividend of only 5%. So he felt very disappointed and almost dejected. He thought that he has invested such a huge amount and that was hard earned. So he felt very disappointed, obviously. So what happened actually? Then he went to his friend, Mr. B. Mr. B is an accounting expert. He has got very in-depth knowledge. He has got tremendous financial expertise. And fortunately, he is friend of Mr. A also, the investor. So investor goes to Mr. B and tells about his story. Now Mr. B, after listening to the entire story, then explains the thing. He tells Mr. A, actually you need not require to worry. First of all, let me clear. Mr. B tells to Mr. A, you need not require to worry, you need not require to be so anxious, you need not require to be so disappointed. You have invested in this particular company, that's fine. But kindly actually do not come to the conclusion immediately. You have just waited for 1 year and at the end of the 1 year you were expecting a very high dividend, but still you got 5%. So you should be happy over that. You haven't lost out your money. Now Mr. B explains further to Mr. A, actually never ever make your decision only on the basis of profit and loss account or for that instance on the basis of balance sheet. You made the decision on the basis of profit and loss account of this particular company, thinking that this particular company's profits are very high and this company has paid very high amount of dividend and you will get the same return. And that is not the case actually, especially after 1 year of your investment. But still, I'm cautioning you, henceforth, whenever you are going to invest, kindly take into account many other aspects. Explained by Mr. B to Mr. A. Now, Mr. B tells you made the investment on the basis of profit and loss account. Well, now you haven't got that much of return. Let me go through the what we call financial position of this particular company. Now Mr. B started scanning the financial position of this particular company. Now in the current year when Mr. A got only a dividend of 5%, Mr. B scans the profit and loss account position, balance sheet, and also the cash flow statement. Now, after having a good look over all the three statements, now Mr. B tells to Mr. B, actually, you need not require to worry, let me clear it. Why you need not require to worry? Because you have simply seen the profitability position of the company. You haven't gone through the cash flow statement. Just kindly pay attention over here. So Mr. B tells to Mr. A, see here, your company has made almost 100 lakhs worth of investments. A very big investment in the current year. It is not a meager investment. It's a very high investment. Also, your company has redeemed what we call nearly 50 lakhs worth of debentures. So if you would have taken a bit of time to scan the cash flow statement, you would not have felt so much of anxiety. Even though in the current year you are not getting that much of return, you got the return only at the rate of 5%, but you need not require to worry. In fact, the position of your company is getting strong. Mr. B tells to Mr. A. Now Mr. A actually suddenly started feeling relaxed. Now Mr. B actually pulls the story further. He tells, actually, the thing is that this cash flow statement shows that lots of cash has been invested by your company in very big projects, so 100 lakhs, it's not a meager amount. And further, you should be happy that your company has redeemed the debenture. It will be very beneficial for you in the upcoming year. I'm very sure in the next year you are going to get a very high amount of return. Even as the years would progress by, your return will also move further. How? Mr. A tells. Now Mr. B again explains, because your company has redeemed 50 lakh worth of debenture, 10% debenture. So that means every year out of profits, your company was paying an interest of 5 lakhs. So your company will not pay this 5 lakh worth of interest now. Obviously, so profits of the company will again rise further, and obviously there will be higher amount of profits available for dividend. And similarly, your company has taken such big and high projects, so in the upcoming year, your return will be much higher. So now Mr. B explains the entire story to Mr. A that you need not require to worry. So point is that you can see the importance of the cash flow statement. If Mr. A would have gone through the cash flow statement, he wouldn't have felt so much of what we call worried and anxious as he is at this particular moment. Isn't it or not? So this is the importance of cash flow statement, and through cash flow statement, we can derive much more deeper, insightful, what we call analysis, and accordingly we can make our investment decisions. So this is the point which we need to take care of. internet has started showing laggings. This is the only problem. Since last few days, this problem has crept in this particular area, but don't worry about that. So this is the point I was trying to tell you. As a professional student, you need to understand that how important role the cash flow statement actually plays and how it plays. Is it clear to you or not? Correct? Now, coming over to the other points, and you are already aware of all these points, what happened? So now, as you know, cash flow statement you used to prepare in your earlier phases of education. I need not require to tell you, when you used to prepare your cash flow statement, you used to prepare it under 3 heads, isn't it or not? One is cash generated from operating activities, cash generated from operating activities. Then cash flows from investing activities, isn't it or not? This is how you used to prepare your cash flow statement in your earlier phases of education, correct? And similarly, in fact, cash flow statement is to be prepared as per AS3 revised, as you know, and AS3 revised states that cash flow statement, whenever an entity would prepare, should prepare it under 3 heads. One happens to be cash generated from operating activity, and below it we have to mention the investing activity, and then finally the financing activity. Isn't it or not? You have already gone through all these things in your earlier phases of education. Now, what exactly cash generated from operating activity, I will come over to that, but what exactly investing activity? Investing activity will encompass all those activities which are related to sale or purchase of what we call asset. For example, if I am going to sell my assets, I am going to write it under investing activity. Similarly, if I am going to purchase land, building, plant, machinery, etc., I am again going to put it over here. Similarly, sale of investment, purchase of investment will also come over here. And besides that, there are some other important items like interest received. If we would receive any interest on investment that is not written under financing activity, it is presented under investing activity. What items fall under it, I have already written in your notes, but I am simply recapitulating. Similarly, under financing activity, what are financing activity? Financing activities are those activities which changes the composition of your capital structure. Your capital structure comprises of basically capital and debt element. Correct. So whenever we are going to issue shares, or whenever we are going to buy back share, or whenever we are going to redeem the preference share capital or issue the preference share capital, all these things will fall under financing activity. Similarly, redemption of debenture, repayment of debenture, raising of loan, repayment of loan, payment of interest, payment of dividend, all these things will fall under financing activity. Honestly speaking, you are well aware of financing activities, investing activities and financing activities. But most important point is that regarding cash generated from operating activity. How to compute cash generated from operating activity? This is a major problem which I have seen. Actually, most of the students know even how to compute it. But why they are doing this, they do not know. This is the problem actually. But before we move further, let me tell you, in your earlier phases of education, you were told that this is how you need to compute your cash generated from operating activity. Cash generated from operating activity. In order to compute the cash generated from operating activity, first of all, you were told, or you used to be told, that write your net profit, and whatever net profit is there, then add some non-cash items. Isn't it or not? In your earlier phases of education, you have learnt it this way around, that in order to compute cash generated from operating activity to the net profit, we need to add non-cash item like what we call goodwill written off, like preliminary expenses written off, like discount written off, discount on issue of shares and debentures written off, like underwriting commission written off. Isn't it or not? Similarly, all these items written off, you used to add it. Similarly, transfer to reserves, transfer to general reserve, reserve fund, it was told to you earlier that you need to actually add them back to the net profit, isn't it or not? Actually, even transfer to general reserve and reserve fund are non-cash item. Remember one thing. Is it clear to you? Similarly, then we used to be told that we have to add some non-business financing expenditure. Non-business financing expenditure. Non-business financing expenditure, what we mean by that? Non-business financing expenditure means such expenditure which are not related to the operations of the business. Operations of the business means sale, purchase, etc. For example, payment of interest. When I am going to pay the interest, of course I have taken a loan and I am going to pay the interest, but this payment of interest is not supporting my operating activity. So it is not connected with operational activity. That is why it is known as non-business financing expenditure. Even such expenditures we have to add back while computing cash generated from operating activity. Similarly, premium on redemption. Premium on redemption of debenture or preference shares. This is again an expenditure which is considered as non-business financing expenditure. Is it clear to you or not? So all these expenditure are considered as what we call non-business financing expenditure. Is it clear to you or not? Similarly, even when we transfer some amount out of profits for the payment of dividend, proposed dividend it is generally called, we have to add this particular item. Again, to be very honest with you, it is a sort of non-business financing expenditure. Is it clear to you? In your earlier phases of education, you used to be told that this is how you have to compute your cash generated from operating activity, isn't it or not? A list of long items you were made to write, and similarly there are some non-trading incomes or non-operating incomes which you need to subtract. Non-operating incomes like interest received. Suppose if you have received some interest on your investment, it is not a what we call trading income. Non-trading income means any income which you are deriving not through sale of product or not through what we call rendering of the services. Then such income is, or such receipt is known as what we call non-trading income. Similarly, dividend received. You have invested in the shares of another company and you are receiving dividend, so it will be considered as non-trading income. So after adding all these items and subtracting this item, we used to arrive over cash generated from operating activity. Actually, honestly speaking, just allow me a second. In order to compute actually cash generated from operating activity, first of all, we need to actually adjust these items to the what we call profit and loss account. Is it clear to you? Because by adjusting these items, we get operational profit from operations. This gives us profit from operations. After adjusting all these items, we arrive over profit from operation. And once we have the profit from operation, then we used to actually here write working capital component, adjustment for working capital components. Adjustment for working capital components means here we used to actually plus or minus current asset and current liability other than cash and cash equivalents. Correct? As far as current liabilities are concerned, if current liabilities are increasing, if current liability used to increase, in your earlier phases of education, you used to actually, or you were told that if current liability would increase, you simply add it, and yes, this is what exactly we are supposed to do, and I will tell you the logic behind that later on. Correct? Similarly, if current liability would decrease, I will have to subtract the same. That means after computing cash from operation or profit from operation, I will have to here adjust the working capital component, and similarly then I will write here current asset. If current asset would increase, then it is considered as decrease in cash, and I will have to write here And similarly, if current asset would decrease, then it is considered as increase in cash, and I will have to add here. After adding all these items, we get actually cash generated from operations before tax. Before tax. And once we get this particular item, then we used to subtract tax paid. Tax paid is subtracted as the last item. And then we used to get cash generated from operating activity. We know actually how to compute it, but the problem is that we hardly know about the logic. Why we need to actually add all these items, non-cash item, non-business financing expenditure, and similarly why we need to subtract the non-trading incomes. This is of paramount importance for you to understand, and once you will be able to understand it, let me tell you, half the battle is won. So we will try to actually just break it further to make you understand. I'm trying to actually give you the logics, correct? You know the art, but you do not know the logic. So, in order to understand that, kindly pay attention. Let us say this is the income statement of a particular company. This is the income statement of a particular company. Income statement of XYZ. This is the income statement of XYZ company, correct? We presume that sales is equal to 1,000 crore. All these figures are in crores, 1,000 crore. We also presume that cost of goods sold is equal to near about, let us say, 600. Cost of goods sold is 600. So obviously this is the gross profit. I need not require to tell that. This is gross profit. Correct? From the gross profit now, I am going to subtract some expenses. See here, I have written A, cash expenditure. Most of the expenses which we write in the profit and loss account, or for that instance in income statement, they are always cash expenditure, correct? For example, salary, for example, rent, for example, prepaid, for example, what we call advertisement expenses, insurance expenses, telephone expenses. Most of the expenses are always regarded as cash expenses. Let us say our cash expenses are equal to 50. But what exactly we mean by cash expenses? This is the point I want you to tell. See here. Cash expenses, when we talk about, it means obviously, let's take the case of salary. Suppose if I have paid salary, what will be my entry? Sir, salary account debit to cash account. Absolutely. I will write this entry, and you have written this entry so often in your earlier phases of education. Problem is that whatever salary which we have paid, it's an expense. No doubt about that. But at the end of the year, this salary is debited to profit and loss account. You now try to recapitulate. When you used to prepare your profit and loss account, you used to write salary on the debit side, isn't it or not? So profit and loss account debit to salary account. Now this is cash expenditure. Why it is a cash expenditure? Because in this expenditure, one, cash is moving out, and this expenditure is also being written on the debit side of profit and loss account. So when we write expenses on the debit side of profit or loss account, either they would be cash expenditure or non-cash expenditure. Now when we say cash expenditure, now it should strike to you what exactly we mean by cash expenditure. Cash expenditure means when I'm preparing my profit and loss account and writing this item on the debit side, it means against this item, some cash is also moving out. That means my cash is also reducing. Such expenditures are known as cash expenditure. And cash expenditure in reality decrease our profit. Only cash expenditure in reality are going to decrease our profit. Remember one thing. Is it clear to you? So 99% expenses are no doubt about that. They are cash expenditures. So salary, rent, as I told you, correct? Similarly, advertisement expense, insurance expenses, whatever printing charges, stationery charges, whatever expenses which you use to actually put on the debit side of your profit or loss account. So we presume that here cash expenditure are 50. So cash expenditure basically means when we are writing this item on the debit side of profit or loss account, it is also reducing what we call cash. Is it clear to you? Now, besides that, there are some non-cash expenditures. Non-cash expenditure. Non-cash expenditure. Now, what we mean by non-cash expenditure? Non-cash expenditure, for example, goodwill written off, preliminary written off, discount written off, underwriting, transfer to general reserve, transfer to reserve fund, transfer to any other fund. Because when we write, even all these items are also put up on the debit side of P&L. But point is that when we write such expenditure, for example, when I am going to write the goodwill, when I will write off goodwill, my entry will be profit and loss account debit to goodwill account. Only one entry will be there. So this time, this item definitely is going to appear on the debit side of profit and loss account, but on the opposite side, there will be no reduction in cash. So such expenditures are known as non-cash expenditure, presuming that non-cash expenditure are also equal to 50. So you must have seen actually non-cash expenditure we write on the debit side of profit and loss account, but theoretically speaking, these items never reduce our profit. In actual term, they reduce the profit theoretically, you can say, but they do not reduce the profit actually in concrete terms, because from the opposite side, cash is not flowing out. Is it clear to you or not? So, non-cash items, and besides that, so that means my profit at this particular moment is equal to 300, and besides that, there are some expenditures, non-business financing expenditure, non-business financing expenditures. Non-business financing expenditure we presume is equal to 50 also, once again 50. Now, non-business financing expenditure are also sort of cash expenditure. For example, as I told you, non-business financing expenditure like interest paid, like premium on redemption, because when I am going to pay interest, my entry will be interest account debit to bank account. Correct? And then I will write profit or loss account debit to interest account. No doubt this is also an item which can be considered as cash expenditure. But problem is that this is non-business financing cash expenditure. Non-business financing cash expenditure means actually these expenditure are not related to our operating activity. They are not related to operating activity, but problem is that even such expenditures are also put on the debit side of profit or loss account. Is it clear to you? So now try to understand. So all these, so you must have noticed actually in the profit or loss account, when we put such items actually, obviously I will write here C, non-business financing expenditure. So my total profit at this particular moment will be equal to 250. Now whatever profit which we get after what we call subtracting all the expenses, that profit is written in the balance sheet. That means that this profit 2,50,000 ultimately will be presented in the balance sheet. Now you should understand that in the balance sheet, when we are given profit and loss account, actually this is not showing my operational profit. And cash flow statement is interested in this particular fact that what is the capacity of your business to generate the profit. So that is why if I want to know, because this profit we know is after what we call subtracting all type of expenditure. But now we know there are some expenditure which are not related to operational activity like what we call non-business financing expenditure. Similarly, there are some expenditure which only theoretically reduce the profit, not concretely, because they are non-cash expenditures. So in order to derive my correct profit, what I will have to do, now this profit which is given in the balance sheet, I will have to add again non-business financing expenditure here, as you can see. That is equal to 50 if I am going to add. Similarly, if non-cash expenditure, that is 50. If I am going to add it back, you can, and if I am going to add, I have written non-business financing expenditure, non-cash expenditure. Okay. So if I am going to add, so I will come to know actually that my true profit is 350. Is it clear to you? Because this 250 is after what? After non-cash expenditure. See, cash expenditure will have to be subtracted. In fact, you are going to subtract all the expenses in order to show your profits, theoretically speaking, in the balance sheet. But problem is that under cash flow statement, we are more interested in cash profit, correct, or profit which are related to operational activity. So this profit which we have arrived is after taking into account cash expenditure, that means operational cash expenditure. Okay, fine. But it also includes what we call non-cash expenditure and non-business financing expenditure. That is the reason this profit is not reflecting our true capacity. So in order to know our cash profit from operations, we have to add non-business financing expenditure also. Is it clear to you or not? So the point is that now I hope you got a fair bit of idea actually why in your earlier phases of education you were told that why you need to actually add all these items. Correct? So if it is clear, that then it will help you later on. So all these items will be added. But at the same time, there are some incomes which unnecessarily increase our what we call profit, which unnecessarily increase our profit, for example, non-trading income. And in order to know our true capacity of the profit, we will have to deduct this also. So that is the reason. And why we add working capital components, that I will explain later on. But at this moment, it is suffice to say actually how we are going to ultimately compute the cash generated from operating activity, because the major part is, first of all, to adjust the items in the P&L and then to arrive at cash from operation. It is also known as cash from operation. And then we are going to actually adjust here working capital component, finally get cash generated from operating activity before tax. And finally, we will have to subtract the what we call tax paid. This is the most pertinent and important and significant part of this particular chapter. If you have understood this particular part, you can take it on guarantee from my side that half the battle you will feel that as if you have won. Why? That immediately you will come to know in the next session. So I will meet you in the next session, and nearly 25 adjustment or 21 adjustment we are going to cover up over there, and that will completely open the entire panoramic view of the chapter before you, and you will feel supreme amount of confidence over there. So now, after having done the initial conceptualities, we shall move over to the practical part in section 1. As you can see, this particular section deals with adjustment. So quite obviously under it, we are going to talk about all the adjustment which we may have to face while preparing the cash flow statement. Now the first adjustment is related to what we call provision for tax, and you are already aware of it. Provision for tax given in the balance sheet 50,000 in the last year, and in the current year it is 70,000. So how we are going to actually incorporate it? As you know, when we prepare cash flow statement, and cash flow statement is prepared under 3 categories, now you are aware of it. The first one is cash generated from operating activities. So cash generating from operating activities, here first of all we write net profit, and then we add all the non-cash expenditure as we talked about in the last session. And besides that, we also add all the non-business financing expenditure, and we also subtract non-trading incomes. So the current year's provision for tax, remember one thing, I'm talking about current year's provision for tax. Now, current year's provision for tax means in the current year you have set aside a part of profit towards provision for tax. In the current year you have set aside a part of profit for the provision for tax. And provision for tax is generally considered as non-business financing expenditure, because now some of you may say, sir, why it is considered as non-business financing expenditure? Because every entity has to pay the tax. No doubt about it. Every entity has to pay the tax, but not because of operational activities, but because of statutory requirement. Correct? So that is the reason it is considered as non-business financing expenditure. And provision for tax, we will have to add first of all over here. The current year's provision for tax we shall have to add here. That means 70,000 I am going to add. And at the same time, under the cash generated from operating activity, as we talked in the last session also, the last item is tax paid. Now, last year's provision for tax which we might have made last year, obviously by the time of the current year or by the end of the current year, this provision must have been paid. So that is why last year's provision for tax will be written as tax paid as last item in the cash generated from operating activity. That means as far as treatment of provision for tax is concerned, that is confined to what we call cash generated from operating activity. Current year's provision will be added and last year's tax paid will be subtracted. So if provision for tax is given in the balance sheet, then there is no problem. At the same time, Sometime you must have noticed provision for tax is given in the balance sheet and some adjustment is also given. For example, in point number 2, it is given last year's provision for tax is 90 and current year 70 and tax paid is equal to 1,50,000. So we have paid tax in the current year to the extent of 1,50,000. So here I will have to prepare a provision for tax account. As you know, whenever there will be an adjustment related to provision for tax, we used to prepare provision for tax account. So here you will have to prepare a provision for tax account, because this time there is an adjustment. When we are going to prepare the provision for tax account, the last year's provision I will be writing here by balance brought down. Balance brought down. Balance brought down will be equal to 90,000 and balance carried down will be equal to 70,000. It will be equal to 70,000. Is it clear to you? Now here it is written tax paid. Tax paid, it is written, that means in the current year we have paid tax, so our entry will be provision for tax account debit to cash account. So I will write here to cash. And when I write here to cash, it means I am writing here tax paid. So tax paid which is given to us is equal to 1,50,000. So I will be writing here 1,50,000. Obviously now I am going to balance it. If I am going to balance it, I will get 1,30,000 as the balancing figure. This 1,30,000 signifies, first of all, here I am going to write by P&L, because this figure signifies that in the current year we have made a provision for tax to the tune of 1,30,000. Remember one thing, when you are going to prepare the account, you are not going to write opening balance and closing balance anywhere else. Is it clear to you? You are not going to put them anywhere else. Now this tax paid, as I told you, will be subtracted as the last item when we are going to prepare cash flows from cash generated from operating activity, as I told you. And this provision which we have made, as I told you, it will be added to the net profit. Is it clear to you? So the treatment will be done with respect to tax paid and provision for tax. Is it clear? Tax paid will be written as the last item and provision for tax you are going to add back. This is with respect to provision for tax. Now coming over to another important what we call adjustment, because there is some confusion with respect to this particular adjustment, so kindly pay attention over here. In point number 1.3, it says that how will you deal with the following items while preparing cash flow statement last year, current year. Now here you are being given equity share capital of the last year is 50 lakh in fact, and current year it is 80 lakh. Besides that, we are also being given property, plant and equipment 15 lakh and 27 lakh. Also it is given that directors declared and paid. Kindly pay attention towards the word paid. Directors declared and paid a final dividend of 10% during the year. This is also given in this particular question. So how to deal, especially with respect to what we call dividend. As you know, when I am going to prepare my cash flow statement, this is my cash flow statement. Under the first one, I will be writing cash generated from operating activity. Then we generally write investing activity. And finally, we write financing activity. Isn't it or not? Financing activity. Now here it is given that directors have declared a final dividend of 10%. What we mean by final dividend, first of all, you need to understand. Final dividend means our final accounts have been prepared. Our final accounts have been prepared. What does it mean? That means our current year is ended. This is beginning of the current year. This is beginning of the current year. And this is end of the current year. Our current year has ended. After the end of the current accounting year, generally it takes some time before we hold the annual general meeting. After the end of the accounting period, generally 1 or 2 months goes by before we held the annual general meeting. And in the annual general meeting, directors of the company decide how much dividend they are going to pay. Now, for example, in this case, directors of the company have decided that they are going to declare 10% dividend, and not only this dividend has been declared, kindly pay attention towards the word paid also. The dividend has been declared and paid. First of all, this dividend, this is known as final dividend because only after preparation of the final account, this dividend has been declared. Correct? That is why it is known as final dividend. Final dividend is always computed on the opening balance of equity share capital. Opening share capital. So our opening equity share capital is 50 lakhs. So kindly rectify your solution. So in case if there are some mistakes. So opening share capital is 15 lakh. You are going to compute 10%. So your dividend in this particular case will be equal to 5 lakh in fact. Our share capital is 50 lakh. So it will be equal to 5 lakh. Is it clear to you? That mean final dividend given in the adjustment as 5 lakh. Is it clear to you? Now, when we declare the dividend, our entry is profit and loss appropriation account or simply P&L account. Generally, we write surplus account. As you know, when we were preparing preparation of financial statement under that particular chapter, when we were preparing the profit or loss account, after that we used to prepare a statement of surplus, and over there we used to write dividend, isn't it? So that means out of a statement of surplus or profit, we have, first of all, we will have to appropriate 5 lakh rupees. We will write here profit and loss account debit to proposed dividend account 5 lakh. That means this amount has been proposed. Now further it is written that this amount has been paid also. So we shall write here proposed dividend account debit to bank account because it is declared and paid. So not only we have declared this particular dividend but also paid it. And remember one thing, like provision for tax, even payment of proposed dividend is a non-business financing expenditure. Is a non-business financing expenditure. Is it clear to you? So first of all, the dividend which you have proposed, because it is a non-business financing expenditure, so it is reducing your profit unnecessarily. So that is why I will have to add it over here when I am going to compute my cash generating from operating activity. Over there, we first of all write net profit, as you know, and then I am going to add here proposed dividend. The dividend which we have proposed is 5 lakh, number one. However, this dividend has been paid also. Now, if we are going to pay the dividend, we will write under financing activity payment of dividend. Is it clear to you? Payment of dividend. So I will write here payment of dividend that is equal to 5 lakh. Now, in this is treatment of final dividend. It is written declared and paid. So whenever it will be given in the question that final dividend has been declared and paid, this is how you are going to treat it. First of all, you are going to add it to cash generated from operating activity, and besides that, you will have to present it under financing activities. Now further here, it is also given property, plant and equipment, last year 15 lakh and now 27 lakh. When our property, plant and equipment is increasing, it means we must have purchased or acquired property, plant and equipment. So that is why here I am going to write purchase under investing activity, purchase of property, plant and equipment 12 lakh. I am going to write here 12 lakh. Is it clear to you or not? So this is how we are going to do this particular question. Kindly pay attention towards the next point also. 1.4. Here it is written, how shall you deal with the following items while preparing cash flow statement? Once again, share capital is given to you as 1 lakh. If nothing is written as prefix or suffix, correct? With respect to share capital, always presume it as equity share capital. And last year's is 1 lakh 50. This time current year's is 1 lakh and last year is 1 lakh 50. Question says that entity declared and paid a final dividend of 10% during the year. And besides that, it is also written interim dividend paid during the year 20,000. Correct? So in this particular question, when I am going to prepare cash flow statement, obviously, first of all, I will write cash generated from operating activity. Then I am going to write investing activity. And then I will write financing activity. Now, just a moment ago, I talked about final dividend. final dividend is always computed on the opening capital. Remember one thing, this time your opening capital is 1,50,000. Is it clear to you or not? Last year capital for current year will become opening capital. So 10% of 1,15,000. Just a moment I told you regarding final dividend. So you can write here final dividend proposed. As you know, first of all, we will have to appropriate a part of profit towards final dividend. So 15,000, first of all, I am going to add to the net profit of the current year. Whatever net profit of the current year is there, I will have to add it. Correct? And this final dividend which we have proposed has also been paid, declared and paid a final dividend. Because it has been paid, so I will have to write it under what we call financing activity also. Final dividend paid. So I will write here final dividend paid under financing activities, that is equal to 15,000. Is it clear to you or not? Now, in this particular question, besides final dividend, you are being given interim dividend paid during the year. What is an interim dividend? See here, when dividend is paid, let us say this is our current accounting year and this is the beginning of the accounting year and this is the end of the accounting year. This is the end of the accounting year. When dividend is declared after the end of the accounting year, and generally dividend is declared in the annual general meeting. Correct? In the annual general meeting, when we declare dividend, this dividend is known as final dividend. It is known as final dividend. And final dividend is always computed on the opening capital. Final dividend is always computed on the opening capital. Is it clear to you or not? Final dividend will always be computed on the opening capital. That means last year's capital. And if final dividend has been declared and paid, as I've already told you, first of all, it is going to be added back to the what we call cash generated from operating activity, and then it will be reflected under financing activity too, isn't it? Now coming over to the interim dividend. What is interim dividend? Interim dividend is one which is paid during the current, in between the accounting year. Now this is our current accounting year. When we are going to pay dividend in between the current year, then it is known as interim dividend. Then it is known as interim dividend. The difference between interim dividend and final dividend, you have already seen that final dividend is generally declared after the end of the current accounting period. Correct? Whereas interim dividend is declared and paid in the current accounting period, in between the accounting period. Now, in case of final dividend, first of all, amount is plucked out of the profit, that means amount is appropriated, and then it is paid. However, under interim dividend, first of all, dividend is paid, and then the amount is appropriated out of profit. However, in both the cases, the situation will remain same. Amount will be appropriated out of profit, and then the payment will be made. However, in case of interim dividend, first of all, we are going to make the payment and then we are going to appropriate the profit. But point is that both interim dividend and final dividend are non-business financing expenditure, so their treatment will remain same. So here also I am going to write interim dividend because we have paid it, interim dividend. So I am going to write interim dividend. What is the amount in this particular question? Interim dividend was 20,000. So I will write 20,000 under what we call financing activity. And because I will have to appropriate this amount, or I must have appropriated this particular amount because our accounting year has already ended. So our profit unnecessarily must have reduced. So that is why interim dividend will have to be added back. So interim dividend, we are going to add it back. So you can see treatment is same, isn't it or not? Another important point is with respect to question number 1.5. Here it is stated that how shall you deal with the following items. Equity share capital last year this time is 50 lakh, in the current year 80 lakh. And director proposed 1 lakh dividend in the last year and 1,50,000 in the current year. It is given in this particular question that directors have proposed a dividend of 1 lakh in the last year and 1,50,000 in the current year. Number one, you have to pay attention. See, whenever word proposed is written, always presume it is a final dividend. Because interim dividend is never ever proposed. It is first paid and then amount is appropriated. So whenever word proposed dividend is written, it means we are talking about final dividend. Very important in this particular case. So director proposed 1 lakh dividend in the last year. And they have also proposed dividend 1,50,000 in the current year. It is given in the question in this manner. So what will be the accounting treatment? See, when I am going to prepare the cash flow statement under it, this is my cash flow statement. Correct? A. Cash generated from operating activity. And C. Financing activity. Here, word paid is not written. Kindly pay attention. Word paid is not written. Is it clear to you? Number one. So last year's proposed dividend, because this dividend was proposed last year. So by the end of the current year, this dividend must have been paid. No doubt about that. We can easily conclude because it was proposed last year. So, because generally when we propose dividend, within next 60 days, we will have to pay this particular dividend. So that is the reason, because this dividend was proposed last year. So in the current year, this dividend must have been paid. Is it clear to you? And that is the reason proposed dividend of the last year, because in the current year it will be paid. So I will write here dividend paid. That is equal to 1 lakh. Last year proposed dividend must have been paid in the current year. So while preparing cash flow statement for the current year, I will have to actually write it under financing activity. Is it clear to you or not? Clear? However, the dividend which we have proposed in the current year. Now here also, in the last question which we did, it was written entity declared and paid a final dividend. Now here it is written that dividend has been just proposed. So when it is written in the question that dividend has been proposed, I am talking about the current year. If it is given only dividend proposed in the current year, word paid is not given. In that case, no treatment will be done with respect to 1,50,000. Why it is so? Because I have written here, no treatment is needed for proposed dividend for current year in the light of AS4. In the light of accounting standard AS4, dividend proposed in the current year, correct, no treatment is required because it is not treated as an obligation. So that is the reason it is not treated as an obligation. That means at this moment you are under no obligation to pay it. Is it clear to you? Because you have simply proposed it. So even Companies Act 2013 says that any dividend which is just proposed in the current year should not be actually reflected, even while preparing the financial statement and also while preparing the cash flow statement. However, dividend which you proposed in the last year, you must have paid in the current year. That's a different thing. That is why we are going to reflect it over here. Now don't add it over here because last year it was proposed. So last year you must have added it in your profit and loss account. Now the point is that actually while preparing cash flow statement last year you must have added it. But here you have proposed this dividend in the current year, but it will not be treated. No treatment is required. Why? Because standard says that, AS4 says that it is not an obligation. So that is the reason we are not going to treat any dividend which is just proposed in the current year. Is it clear to you or not? So this is the important point which you need to pay attention as far as this point is concerned. Now again 1.6, pay attention. Again equity share capital is 50 lakh, 60 lakh, 15 lakh, 27 lakh. Correct? Now it is given directors declared a final dividend at the rate of 10%. Declared a dividend at the rate of 10%. Again, no treatment, because here it is not written director declared and paid a final dividend. It is not written in the question. Are you getting my point or not? So because word paid is not given, so no treatment is required. Word paid is not there. However, if word paid would have been given, in that case, I would have computed 10% of 50 lakh, 5 lakh, and then I would have added what we call 5 lakh to the cash generated from operating activity, and also 5 lakh I would have had written under what we call investing activity. Is it clear to you? So, director declared a final dividend of 10%. So again, since dividend has been declared under AS4, it is not a liability, so shall not be recorded in the financial. As such, no treatment is needed for what we call dividend declared. Is it clear to you? So in this particular case, your equity share capital is going up from 50 lakh to 60 lakh. You can write it under your financing activity issue of equity share capital. Property, plant and equipment is going from 15 lakh to 27 lakh. You can simply write purchase of property, plant and equipment, and no further treatment as needed. Is it clear to you? 1.7 now. How shall you deal with the following items while preparing cash flow statement as per AS3 revised? So how shall you deal with what we call following item? Now all these adjustment now till up to this particular stage, we did adjustment related to what we call provision for tax and final dividend and interim dividend. Now we will pick up 1.7. Here, these adjustments are related to your fixed asset. Last year it is given 5 lakh. In the current year it is given 8 lakh. Below it is given during the year a part of fixed asset costing 2 lakh. Accumulated depreciation provided 1 lakh was sold for 80,000. While another part costing 50,000, accumulated depreciation provided rupees 30,000 was scrapped. So in this particular question, I will have to prepare a fixed asset account. Is it clear to you or not? In order to prepare the fixed asset account, what I will have to do, obviously I will have to prepare the fixed asset account. So I will prepare the fixed asset. First of all, I will write here fixed asset account. This is your fixed asset account. At least because it is an asset account, so I will write balance brought down, opening balance brought down, that is equal to last year balance will be written as balance brought down, that is equal to 5 lakh. Now your current balance is your 8 lakhs, so you are going to write balance carried down as 8 lakhs. Is it clear to you? Now in this particular question, see here, it is written during the year a part of fixed asset costing 2 lakhs. So cost price of the fixed asset is equal to 2 lakh. A part of fixed asset costing 2 lakh, accumulated depreciation provided 1 lakh. We have already provided depreciation to the extent of 1 lakh on this particular property, plant and equipment or fixed asset. So cost is 2 lakh and accumulated depreciation is 1 lakh. So quite obviously it means the written down value or the book value, written down value or book value of this particular asset is equal to 1 lakh. And now question says that we sold this one for 80,000, less sold. So we sold for 80,000. If we are selling it for 80,000, that means 20,000 is loss. Obviously, if the written down value of the asset is 1 lakh and you are selling it for 80,000, there will be a loss of 20,000, isn't it or not? So there is a loss of 20,000. Correct? Also it is given another part costing 50,000. Now another part of the fixed asset is there and it is having a cost price of 50,000. So you are going to write here 50,000. Another part costing 50,000, accumulated depreciation provided 30,000. And on this particular part, we have provided depreciation to the extent of 30,000. So that means the written down value is equal to 20,000. isn't it or not? Was scrapped. Was scrapped. Another part costing 50,000 having accumulated depreciation of 30,000, that means its written down value is 20,000, isn't it or not? Now question says that it was scrapped. It was scrapped means we simply threw it out. Indirectly it means it was sold for nothing. We did not receive anything out of this particular asset. So that means again there is a loss of 20,000. So now we can say total cost 2 lakh plus 50 is 2 lakh 50,000. Total cost of the asset is 2 lakh 50,000. And total accumulated depreciation is 1 lakh 30,000. So you are going to write 1 lakh 30. And total written down value is equal to 1 lakh 20. And as you can see, total sale value is equal to 80,000. So 80 minus 120 will be equal to 40,000. So 40,000 will be your loss. So we can simply post the last what we call column. Now you can see here the accumulated depreciation is 1,30,000. Sale value is 80,000 and loss is equal to 40,000. Accumulated depreciation, sale value and loss must be posted in the what we call fixed asset account. So I will be writing here first of all by bank or by cash, total sale. Now total sale value as I told you is 80,000. That is 80 plus 0, 80,000 is the total sale value. So I will be writing here 80,000. Correct? Total accumulated depreciation. Total accumulated depreciation as you can see is equal to 1 lakh plus 30, that is equal to 1 lakh 30,000. And there is a loss also to the extent of 40,000. Now if I am going to add all these three items, 80 plus 130 plus 40, it will be equal to total cost price. Is it clear to you? So anyway, this is how we will have to post it. Now we are going to tally it. If I am going to tally it, because this is an asset account, if we are preparing an asset account, we are going to get a figure of cash purchase or what we call cash sales. In this case, first of all, balancing figure is appearing towards the debit side and it will be equal to 5,50,000. So this will become your cash purchases. So you are going to write here to bank purchases. That means in the current year, you must have purchased fixed asset to the extent of 5,50,000. Just a moment ago, I also told you, opening and closing balance will not come anywhere else. Is it clear to you? But all other things must be posted. For example, when I am going to sell the asset, I am going to write it under investing activities. These are investing activity, 80,000 sale of fixed asset. Accumulated depreciation will be added. So accumulated depreciation will be added to the cash generated from operating activity. Loss will also be added over here. Loss on sale of fixed asset will also be added to the cash generated from operating activity. And this 5,50,000 will be written under investing activity. So 5,50,000, that is purchase and sale, will come under investing activity. And accumulated depreciation and loss, I need not require to tell you, will find place what we call under cash generated from operating activity. Is it clear to you or not? So this is how you will have to do the treatment of this one. Similarly, now we move over to 1.8. Here it is written plant and machinery 5 lakh, 8 lakh. And below it is given 50,000 depreciation was charged on plant and machinery. However, it is also given a piece of machinery was sold for 8,000 during the year and its cost price was 12,000 and depreciation was 7,000 on it. Cost was 7,000, depreciation was 7,000 and it was sold for 8,000 during the year. Because some information is there, so we will have to prepare the account. So when I am going to prepare the account in this particular case, I will prepare plant and machinery account. First of all, I will be writing balance brought down, that is equal to 5 lakh once again. This question is 1.5, I think so. Sorry, 1.7. 1.7, no? 1.8 in fact. This is 1.8. So well, we were talking about what we call balance brought down. Then I will write here balance carried down, that is equal to 8 lakh. In this particular question below, it was given total depreciation charged on plant and machinery is 50,000. This is the first information. Then another information is given that machinery has been sold for 8,000, its cost price is 12 and depreciation provided is 7,000. Cost price of the machinery, as you can see, is 12,000 and accumulated depreciation is 7,000. So that means the net book value is equal to 5,000, that is written down value. Now we have sold it for 8,000 rupees in this particular case, so I will write here sold for 8,000. So this time we are having a profit of 3,000. This time we are having a profit of 3,000. Is it clear to you? This is a profit. Just a moment ago I told you accumulated depreciation, sale value and profit or loss must be posted. So when we are going to prepare the account, first of all I will be writing here by cash or bank, whatever you may like to write. Sale. We sold it for 8,000, sorry. So I will write here 8,000. Accumulated depreciation provided is 7,000. So I will write here 7,000. However, this time there is no loss. Rather, there is a profit. So profit obviously I am going to write over here. Moreover, if any asset will have profit, the asset must be debited. So profit is equal to 3,000. Now you can see actually 8 plus 7, 15 minus 3 is equal to cost price. Is it clear to you? Now we are going to actually tally it out. If I am going to tally it out, before we tally it out, there was another information I forgot. There is one more information that total depreciation charged is 50,000. Total depreciation charged is 50,000. Now see here, I am going to write depreciation. But out of 50,000, 7,000 I have already written in the form of accumulated depreciation. I have already written what we call 7,000, so now I will be writing 43,000. Indirectly I have written only what we call 50,000. Is it clear to you? So it will be equal to 3,55,000 I think. So 3,55,000 this is your balancing figure. And this balancing figure, as you can see, is coming towards the what we call debit side. So you are going to write here as cash purchases. This will become your cash purchases. Is it clear? Now so many times I have already told you, opening and closing balance will not find any place because they have already been written in the balance sheet. Correct? Now, cash sale we are going to write under investing activity and purchases also under investing activity. Besides that, in this particular question, accumulated depreciation and depreciation will be written under cash generated from operating activity. And even profit on sale of fixed asset will be written under cash generated from operating activity, but we are going to subtract it. This is how we are going to present it. See here. You can see this is your cash generated from operating activity. I have subtracted 3,000 profit and also added what we call total depreciation 7 plus 43, that is 50,000. And under investing activity, we have written purchase of fixed asset and sale of fixed asset. Is it clear to you? This is how we are supposed to do this particular question. Now, before we do next question, correct, we will take a short break. In fact, we are closing down this particular session and I will continue with the discussion in the next one.